So good morning. Is it only Faith is it?
Good morning.
Right. I think we will. Oh, that's it. Okay. Right. Yeah. So we have started on this question, and remember we had done point. We just have so let me hope we are together to that point. Yeah? You have it at the back. Yes. Are you hearing me?
Yes, but the voice is a bit faint. So I'm actually trying to see whether it's my speaker from my end.
Okay. What I'm asking is, yeah,
Yes.
you have the workings to number 3 because we had done up to working number 3 yesterday. We had solved the question to the point we had the depreciation expenses, yeah, the ones on buildings and the ones on land, yeah. So do you have it?
Yes.
You have to that point, right?
Yes.
Right. So the next note is then note number. And look at note number 4. Let's look at this note number 4, yeah. And we are told that on 30th June 2023, the company revalued its land and buildings to 190 million shillings, including 2.5 million, we are told, for the land. The company follows the revaluation model of I-16 for its land and buildings, but no revaluations had been carried out. The company wishes to treat the revaluation surplus as being realized on disposal of the asset. Yeah, so that note is talking about revaluing two assets. One is the land, and then the other one is buildings. Yeah, and normally when you revalue an asset, you have two possibilities. Yeah, and so is working number 4. Let us be looking for the revaluation what? Surplus or deficit. Let me call it for the year, yeah? For the year. And whenever you revalue an asset, remember that you give the asset a new value. The new value is what under revaluation we shall call the fair value, which when you compare to its book value before you revalued it, then of course you end up with what we are calling a surplus now or a deficit, yeah? So to then compute the surplus or a deficit, compare number 1, what is their new value? What's the new value for the land and buildings? When you look at note number 4, we have been told that for the two assets combined, their new value, we have 190 what? 190 million. In this case, I can work with 190 what? Now, 1,000. Compare this with before you revalue the debt, what is their book value? Their book value is what we have commonly called NPV. what's their net book value before we revalued them. And by the way, net book value before you revalued them is the same as what? I'll come here and say that we have equal to, yeah? I'll go back to the trial balance where I have the book value info, and the land and the buildings we have 210. The land and buildings combined, so 210. Remember, minus, so far to the start of the year, we had accumulated depreciation of this 30. So that 30. And then you proceed to say that minus again, when you go to working number what? Our working number 3. Our working number 3, one of the assets depreciated, you know, we have buildings, yeah? So again, you must minus that depreciation on buildings. And when you do that, we end up with how much book value? This is 175, now 840. And so the difference between that and their new value is what we are looking for, yeah? And the new value is more than that book value by, the difference is this 190, now minus 175, that's about 14, 160, yeah? And when the new value is more, is this 14, 160 a surplus or a deficit?
A surplus.
Yeah, that is a revaluation surplus. So just note that we have surplus. And later, as we prepare our P&L, this surplus will be treated as other what? This one will treat as other comprehensive, now income. So later in the P&L, that will be part of the other comprehensive income. And if that is the case, then we can proceed to working number 5. And so we can have working number 5 as a value for PPE that later we take to, the balance sheet. And how do you determine this? You know, we had said that what IS1 require is that because items of PPE are very many, you cannot in the balance sheet present them individually. Rather, we have said that you should consolidate, you should combine them, and so in the balance sheet, present one figure that call PPE. So in this case, we'll appreciate that we have which items of PPE? One, we have land and buildings. One, we have land and buildings. Now these ones we revalued, and you know we revalued them at the date we report. In that case, whenever you revalue, you should work with the new value, yeah? Whenever you revalue, you should work with the new value. And these ones we revalued to a new value, which is how much? This 190. You revalued to 190. When you revalue, you then work with the new value. So 190. We then, to this add, the next PPE was a plant and equipment. So plant and equipment. Now these ones were not revalued. We therefore work with their net book value, and their net book value equals what figure? We go back to the trial balance again, where for plant and equipment, their cost was this 64, now 5, minus the accumulated depreciation, we have this 31.5. And then in the workings, you have two more adjustments to make. One, you have to say that minus also, you know, we had disposed some equipment, and the net book value of what we disposed was the 3,000 shillings. Now that's working number 2, the 3,000 in working number 2, and then minus also, you know, we have this depreciation for the period, still for the plant and equipment. So still for the plant and equipment. And then, so that is it. The plant and equipment, their value comes to that 24,000, yeah? And with that, you can then combine them. We can then combine them and look for the total PPE that later, yeah, now goes to the balance sheet, and that is 214. So later for the balance sheet, I will say that PPE, we then have 214. Working number 6. We proceed on to the next note. And in that case, we can look at note number 5. We can look at note number what? 5. In note number 5, we are told that expected credit loss. In bracket, it's clear that that's an administration expense is on average 10% of the trade what? The trade receivables. And so as working number 6, we'll say that we have an expense that we call expected, an expense that we call expected credit loss. This is what we commonly abbreviate as ECL, as per, of course, IFRS 9. And as an expenditure, the question says that we provide for this at 10%. Now 10% of what? Of the trade receivables. So it is 10% times, when you go back to the trial balance, yeah? The trade receivables are somewhere. And this I can see is 130,000. So 10% of it will be our what? Our expected credit loss, which is an expenditure, and that comes to about 13,000. The question has said that as an expenditure, include it under the administration, yeah? Include it under the administration expenses. So later for the administration expenses, we will appreciate that we then have that 13,000, which is the expected credit loss as an expense, yeah, as an expense. After that, we can proceed on to note number what? Let's look at note number, this is note number 6. And note number 6 says that the income tax charge and current tax, or rather and deferred, or rather the income tax are charged in bracket. This comprises current and deferred tax. For the year is estimated at 11,250, of which 4,250 relates to future payable tax on revaluation of land and buildings to be charged. Remember, another comprehensive income, and then in bracket and the revaluation what? Now surplus. So that note is talking about the concern under IS 12, which is the income tax expense. And it's very clear. It's very clear in this note that it comprised current and deferred taxation. Now the estimate for the current year is 11,250, of which this 4,250 relates to the future payable tax. Remember, on revaluation of what? Now land and buildings, yeah? So allow me to remind you that when you come to this working number 4, yeah? The question is, or rather as per the question, we computed a revaluation what? Surplus. And when you have such a surplus, now how do you account for it? With a surplus, you debit the asset that you devalued. Like in this case, we shall debit what? We shall debit the land and buildings. You know, a surplus means that you have increased the asset in value. So you debit land and buildings with a surplus, which is that 14. Now 160, what do you credit correspondingly? What happens is that when you have a surplus, it's more like a gain. And you know, a gain is more like an income which you must tax. And so whenever a surplus occurs this way, the surplus attracts some taxation. And the taxation it attracts is what we call deferred, yeah? Is what we call deferred tax. Is what you call deferred tax. Meaning that you'll need to credit the deferred tax account. You need to credit the deferred tax account with how much tax is on this 14,160. Ideally, the 14,160 should be computed as what? Or rather, the tax on the 14,160 should be computed as the surplus. Should be computed as the surplus. Now times tax rate. Times tax rate. So times the tax rate. So that the surplus is 14,160. And so that the surplus times tax rate, the surplus times tax rate, you know, the surplus is this 14,160. Now tax rate we have not been told, the tax rate we have not been told, but assuming that it is something like 30%, then the tax on the surplus would be this 42,80. But look at what the question talks about in that note. This note number 6 once again. In this bracket, we are told that out of this 11,250, in bracket, we are told, yeah, that of which for the 250 relates to the future payable tax on the revaluation of the land and building. So the question already computed for us the tax on the revaluation, and this we are told is 42,50. So ideally, with the surplus debit, the asset revalued. In this case, this is the land and what? Buildings. And then correspondingly credit the tax on the surplus, which we are told is 42,50. But I've said we're not given this is how you would do what, this is how you would compute it. But furthermore, you realize that this figure and this figure are not far apart from each other, difference of 2 actually. And so if the debit is a 14,160 and credit so far we have 4250, we need another credit which is this 14,160 minus this 4250. That's about 9910. And where does this other credit go? The other credit goes to the revaluation. The other credit goes to the revaluation reserve account. The other one goes to the revaluation reserve account. And if that is the case, what I want us to do next is I want us to prepare. I want us to prepare an account for taxation. I want us to prepare an account for taxation. So in coming up with the accounts, you just work with the borders, yeah? Like the top of the account, I can work with that bottom border. And then still with the borders, I can take the left border so that this is now income tax. Let me call it income tax account. So the income tax account, the income tax account. All right, so let's agree that the tax provision we are told is what we estimate at this 11,250. You know, a provision is a liability. A provision is a liability, yeah? And that means that with the 11,250, you credit liability account. Liabilities are normally credit. So you credit liability account. Remember, correspondingly, you now debit the income tax account. You say that we have 11,250. And what is this 11,250? Let me just say that this is the tax what? Tax liability. That's the tax liability. Now, or provision, the tax liability, or provision. I want you to remember that with respect to this revaluation surplus, the 14,160, we have said that we have some taxation. This taxation is what we call the deferred what? The deferred tax. And we've said this one you should credit in the tax account. So I come to my income tax account, and on the credit, I say that I have this 4250. So that 4250, I'll narrate that this is a PPE. This is a PPE. Now revaluation. So revaluation tax. So that is a PPE. Now revaluation what? Tax. If that is the case, then we are done with this account. And if we are done with this account, we can balance it. We balance it off. And when we balance it off, you are realizing that debit is more at 11,250. The credit will also have the 11,250. Now, what we are looking for is the balancing what figure, yeah? And that balancing figure comes to about 11 to 50 minus this 4250, yeah? So that's about 7,000. And the question is, what is this 7,000? So you have to remember that in the P&L, we need tax expenditure, which ideally we debit in our P&L, yeah? So what we shall minus from our profits as a taxation expense for the period is there for this 7 million, yeah? So this one goes to the profit or loss, the profit or loss statement as the tax expenditure. All right, so let's proceed on to the next note and the next working. And that will be with respect to this note number 7. And what are we told in note number 7? That on 1st of January 2023, Finacial Limited made a 144 bonus issue, capitalizing its general reserve. You know, a bonus issue is normally the issue of shares to existing shareholders for free. And if that is the case, the company must internally finance the bonus issue. And bonus issues are normally financed by the company utilizing one of the reserves that exist currently. That is why you are told that they had capitalized the general reserve. There below, you are told that this transaction has not yet been accounted for. And that's why you are being told about it, so that you account for it. So when you do a bonus issue, the first thing that determine working number 8 is what is the value? What is the value of the bonus what? The bonus issue. The value of the bonus issue equals how much? Now this is very simple to compute. The question says that it was a what for what bonus issue. What was the share exchange in this bonus issue? It was a 1 for 4. It was a 1 for 4, meaning that we shall take 1 over 4. 1 divided by 4, 1 of 4. So 1 over 4, you multiply by the ordinary share capital, yeah? So you look for the ordinary share capital, which in the trial balance is this 25,000. I'm doing that because the share capital is normally recorded at par. And bonus issue being a free issue, we also do it par value. So very simply, calculate the value of a bonus issue as the share exchange 1 over 4, like in this case, times the share capital at par value. And that gives us about 62.50. This is then accounted for, yeah? So this is then accounted for, remember, by debiting. This is then accounted for by debiting and crediting what? The question has said that we capitalize general reserve, meaning that you debit the general reserve. So debit general reserve, and that means that you decrease the general reserve and then correspondingly credit the ordinary Now share capital, that's an issue of shares, and so you increase your share capital. Let's go to working number 9. What are we told in the next note? The next note and the last one is note number 8. And what are we told here? That Finacial Limited uses the fair value model of IS40. The fair value of the investment property as at the reporting date, we are told was 147 what? million shillings. Yeah. Now, when you go back to the trial balance, you know, we are told these assets are these are the fair value. Now, the investment property, that's what they are called. When you go back to the trial balance, somewhere you have the investment property, yeah? And the investment property was, they were here, 137. So their book value before year end, we have 130 what? 137. As we are then told in note number 8, you know, the investment property are accounted for as by International Accounting Standard number 40, just as what you are told, yeah? And one of the most important provisions of IS40 is that we value them based on what we call the fair value model. And what the fair value model wants is that at every date you report, you adjust their book value to their fair value. We've seen in the trial balance that their book value, we have 137, whereas now at the date we report as per this note number 8, their fair value, we have 140 what? 147. So you must do the adjustment from the 137 book value. Now this 147, now book value. Let me make this sound very simple, yeah? It's more or less like at every date you report, you revalue this property. And we had said that revaluing means that you give an asset a new value, which is their fair value. Now compare that with their book value to see whether you have increased or decreased them. Now then in value. As working number 9, I will say that I have fair value, I have fair value, I have fair value, gain or loss on investment, gain or loss on investment property, gain or loss on investment property, fair value adjustment. And because this is the same as what we have done under revaluation, compare their new value, and their new value is the same as their fair value. Their new value is the same as their fair value. The new value is the same as their fair value. It's the same as their fair value. It's the same as their fair value. And note number 8 is clear that their fair value, we have 147 million. We compare that with what was their book value before the fair value adjustment, and their book value is the one as per the TB, the one as per the trial balance. And in the trial balance, we have 137 what? Million. When you then compare the two values, you know, we have a difference of 147 minus 137, and this one will be what we call a fair value. This one will be what we call a fair value what? Gain, because the new value is more. And just like we said, we treat the revaluation reserve, the fair value gain will also be part of the other comprehensive what? This one will also be part of the other comprehensive, now income still in the P&L. So it will be part of the other comprehensive income, still where? Still in the P&L. And I think that that is it for the additional info. That is it for the additional info, yeah? It's not possible to accurately do what the questioner require. That is, do the financial reports without these workings. So I don't know how you'll do it in exams, but remember the workings have no marks, yeah? And so you have to see on how very quickly you have them before you put your more emphasis on what the question wants. You know what is wanted are the three financial reports. These number 1 to 3. And so far we have not yet done any, yeah? So let us then proceed to the first one. Let's start with the first financial report. And you must start with the title. You must start with the title, remember, so that part one or part A, the title is Finacial. We say that limited. And what we are preparing is the statement of comprehensive. The statement of comprehensive. Let me simply call it income, and this is for the period 2, for the year 2. For the year 2, the reporting date is 30th June. Now this is 2023. I think we are told that is 2023. And we are reporting in shillings in thousands. Our level of precision is shillings in thousands. The level of precision is shillings in thousands. And if that is the case, then now for the income statement, what is the starting point? The starting point is normally sales or revenue, whereby in this question we have revenue. So I'll start with we'll start with the revenue. We'll start with the revenue, and we did not in the workings see that there was adjustment on revenue, and so we very simply pick what we have in the trial balance, and this is this 662,000. We haven't seen on any working that goes to the revenue, and so that is it. So that's 66 or 662 now 1,000 shillings. And I think before we continue further, would you be having any question on the workings which we have done so far? Would there be any question? Ian, good morning. You just joined us?
Yes, morning.
All right, so is there any question from any of you on the workings which we've had?
No.
Actually, yes, I have a question. I wanted to ask. So, when you're talking about a bit of topic, fair value and the revaluation, The concept is the same, but it's now just the different standards that are covering, or
Yes, the concept is the same, yeah, but the assets on which we determine them, yeah, are governed by different accounting standards. Yeah, you know, revaluation is normally strictly on a PPE. The PPE is governed by International Accounting Standard number 16. Yeah. When you come to the investment property, you are now looking at a different accounting standard as 40. And examples of investment property are like the financial assets, whether it is through profit or loss, or whether they are the financial assets available for sale through fair value. Such are what we call the investment property. So the concept is rather the same, but then because of their difference in accounting standards, then we term them differently. But of course, the accounting is very similar.
okay, so yeah, okay. Of which now the follow-up is now, will we going to be in this business data analytics? You can go into finding the fair values and the revaluation calculations. They can bring questions in that format.
To find fair values?
Yeah, to actually do the calculation.
No, not
And
really. Not
okay.
really. As far as this particular area is concerned, yeah, you will directly be provided with the fair values, yeah. So you don't need to bother reminding yourself of how you compute them, yeah. You won't be tasked, you won't be taken through that, yeah. So you
Okay,
will have
thanks.
the fair value readily available, just like we have seen in this question, yeah. Sawa.
Okay, thank you.
All right, so we continue with our income statement. And so next we determine our cost of our sales. So once you have sales, next we have cost of our sales. The cost of our sales, how will we compute it? Let me say that equals what? Let's go back all the way to the trial balance, yeah? Let's go back all the way to the trial balance. Now, how do you normally compute cost of our sales? So you normally compute cost of sales as what? As opening stock first, so that when you look at the trial balance, we have opening inventory, which is this item 3 in the trial balance. So it's normally opening inventory, remember plus what? Plus purchases. So plus that purchases figure. And then it's normally minus, go back to the workings. Working one, you have closing stock. Working one, you have closing what? Closing inventory. So it's opening stock plus purchases. The opening stock plus purchases. And then minus the closing stock, which we had in working number 1. We had that in working number 1. And then you have to remember in the workings we had said that certain expenses in the workings, they go to the cost of sales. So we say that plus. One of them was this working 2, we had this disposal loss, and then plus also working number 3, there was this disposal on plant and equipment. I don't know whether we have another one. When I check down there, I do not have another expenditure that I say should go to the cost of what? Sales. That means that the cost of sales comes to about 400 and what? 440. But remember, we need this as a negative. So I'll just put minus and then the whole of this in bracket. We need the cost of our sales as negative, that 440. And if that is the case, we can now compute our gross what? Gross profit. So remember that compute the cost of our sales as normally the opening stock plus purchases and then minus closing what? Stock, and then proceed to adjust for the expenses which we have seen as per the what? Workings. Now look here. Do not come to this P&L and start saying that your cost of sales separately, you have opening stock, you have purchases, you have closing stock. You'll get a zero, even if those figures are correct. We only need one figure for the cost of our sales here. The published financial statements are normally very summarized financial reports, very summarized. And that means you cannot afford to have breakdowns. All you need are the final figures. Like now for the cost of our sales, I'll be looking for this final what? Now final figure. If that is the case, then we can compute our gross profit. And our gross profit will come to 222. So that is 222. That is 222,000. That is 222,000. And if that is the case, then before you can minus expenditures, you check whether we have the other operating incomes, yeah? Are there the other operating incomes to add to the gross profit? I'll go back all the way to the trial balance and check whether we have the other operating incomes. And the moment you have this investment property, most probably you will have the other operating incomes. And I can see that we have this rental income thing, yeah? So the rental income, that will what? The rental income, that will be part of the other operating incomes. So I'll come down here, and of course I'll say that we add to the gross profit. Now the other operating incomes, yeah, so note that fine, we know that the other operating income is the rental income, but not come here and say that you have rental income, yeah? Generalize them as other operating incomes. When you have several, then you'll need to add them up, yeah? When you have several, you'll need to combine them so that you have only one item that you call the other operating what? Income. So we'll say that this one equals, I will go back to the trial balance. The rental income is what figure in the trial balance? Yeah, it's this 12,000 shillings. So that is it. So I've said that in case you have a number, in case you have two or more, again, you cannot separate in this balance, in this income statement, you combine all, and here only state now one figure. And if that is the case, then we proceed to add them. We proceed to add them downwards so that we have 234, yeah? Now 234,000. We can then proceed the other operating expenses. And the other operating expenses are, you'll now be left with only three categories. One is the distribution costs. One is the distribution costs, and then the next one should be the administration expenses, and then the last one we had said is the finance what? The finance cost. Now, please do not forget that as per the requirement of IS1, you have only 4 categories for expenses. You cannot have anything outside the 4. All your expenses you must classify into this, which we have called the cost of sales, and these are the 3, so that your expense categories must be the 4 categories. Every expenditure that you therefore incur, you must classify under one of the 4 what? Now the 4 categories. Let's look at the distribution cost first. And the distribution cost, I'll go back to the trial balance again. So I say that equal to the distribution cost is the 4th item in the trial balance. Now it should be that 128, and then check the workings. Did we say anywhere that we have a distribution expense to be added to the distribution category? Now I haven't seen any. All what we saw, we had agreed that we take to the cost of our sales and then the administration. So the distribution cost is just what the question gave. That's the 128. And I want that as a negative what? Negative figure. So negative 128. Let's go to the administration equal to negative, and then I bracket. Now in the trial balance, the administration is how much? After distribution cost, we have admin of this 86.5 plus in the workings, we saw that we have something for this category. And you start with this working number 3, where we had depreciation on buildings, that 4160. And then plus again, you come to working number 6, the expected credit loss of this 13. The expected credit loss of that 13. And if that is the case, we adjust the administration expense to about 103. Now 600 and what? 660. The last expense category, we have the finance cost. And the finance cost, you have to look for the loan on which we are computing it. And the loan or a credit on which we are computing it is which one? Look at this. Look at in the trial balance, the last item we have a loan. Yeah, we have the 8% loan stock, and that means that the interest on it, finance cost is interest. Remember, yeah, the interest expense on it for the whole year is then the loan amount this 37.5. So the loan amount 37.5, and then times, you know, we are told it's an 8% loan. So the interest is therefore times the 8%. And I'll just put minus before one of the 2 figures so that I have that thing as a negative in the P&L. So that gives me about 3,000 shillings. Then as the interest cost. So then as the interest cost, finance cost is our interest. So whenever you want it, look for your loan. Look for the loan that you have, yeah? And so this one will give us our profit before tax. Let's compute the profit before taxation. And the profit before tax is this 234 minus the 3 expenses. Down there we get about, it is actually a loss. It is actually a loss of 660. So this one will be a loss before. This one will be a loss before now tax. That one will be a loss before tax. the company has made a loss before taxation, an accounting loss before taxation. And so next we proceed to how much is our income tax expense. So how much is our income tax expense? And for this one, I want you to refer to working number. We have working number what? Working number 7, yeah? Where we had prepared the tax account. And in working number 7, we had said that how much tax do we bring to the P&L? Yeah, we computed these 7,000 shillings, the tax that you bring to the P&L. We calculated 7,000 what? Shillings. That is what we now bring to the P&L as a minus, because tax you minus. So tax you minus. And if that is the case, then we add them downwards. So that with that we get our loss. We get our loss after. Our loss after tax. We get our loss after what? Tax. At the point of our profit or loss after tax, you then introduce what we have called the other comprehensive what? Incomes. So you then introduce the other comprehensive incomes. You then introduce the other comprehensive what? Incomes. So now, in our workings, we have seen that we have 2 other comprehensive incomes. One is the revaluation surplus. Remember, for the year, and this one was a working number. The revaluation surplus was working number 4, yeah? When you look at working number 4, we had the revaluation surplus of for the period of how much figure? The revaluation surplus was this 14,160. And then we have seen that the revaluation surplus of 14,160 attracted some taxation. Being again, it attracted some taxation, so that we need the tax effect on revaluation. Now surplus, the tax effect which reduces the surplus, we saw that is what figure? We saw that this is this 4250. So you minus the 4250. When you tax something, you reduce it. So you minus the 42 what? The 4250. The next other comprehensive income, we had the fair value gain. The fair value. There was the fair value gain on investment again for the year. Yeah? Let me just call it the fair value gain for the year. Now this one was the last working. So working number 9. So that was the last working. So in bracket, I'll say that working number 9. That was a figure of how much. So we computed this 10,000. Yeah. We computed the 10,000. So a surplus is a plus. That's why it's a positive here. And then you reduce it by the tax effect on the surplus, which is this 4250. And then the fair value gain is also a plus, so you add it. For the fair value gain, we were not told that we should tax it. For that reason, the question even never gave the tax on it. Like we do have the tax for the revaluation surplus. And if that is the case, then lady and gentlemen, we are done, yeah? We are done. You then get what we call the total comprehensive income. And this is for the year, yeah? That's for the year. Remember that you will add them all the way from the loss after tax, and that gives us about 12,200 and what? 250, and that is it. That is it for the first financial report. That's it for the statement of income. So unless somebody has a question, then of course we will proceed to the next financial report. Nani yako na swali? Nani yako na swali? Is there any question? All right.
Yes. I have a question.
Yes.
I've seen like how you have treated the deferred tax here on the revaluation. You have it under other comprehensive income. So in a case where sometimes you can get you can get a question which just which straight up just talks about the the deferred tax, but not specifically about the revaluation. Just to be clear, anytime we have the deferred tax, we take it to the other comprehensive income. Or
no, the answer to that is a straight no. The deferred tax which you bring to under revaluation must be the one specific to this revaluation surplus.
Oh, okay.
So unless it is for the revaluation surplus, you can't bring it here, yeah? When you have a deferred tax, it is part of your income tax expenditure. Actually, remember that for this taxation, yeah, you apply the provisions of IS 12. IS 12 is about income tax, where we do consider two taxes. One is the current, and then plus the other one that we call the what? The deferred. So the normal deferred tax will just be part of the income tax expenditure. Yeah? So unless it's for the revaluation, then it will very simply be just part of our income tax expense. Sawa.
Okay.
All right. Okay, so let's proceed on to number 2. And once again, we have to start with the title, yeah? Finacial Limited. And then what are we now preparing? We are preparing a statement. We are preparing statement of changes in equity. And this is for the year, yeah? For the year 2. The year 2, we have 30th June. And this is 2023. Now, the first thing that we will do is to find out which items of equity do we have by this company, so that which items of equity do we have. Of course, we have to arrange the items of equity in columns, just like we said yesterday. So find out which ones we do have, and then proceed to arrange them in columns. If I go back to my trial balance, let me just see which ones I do have in the trial balance. Yeah. Of course, I can see that we have the ordinary share capital. I can also see that we have the share premium. I can see retained earnings, and then I can see general reserve. Yeah, I do not think in the trial balance we have more than that. So in the trial balance we have the 4. Yeah. So I'll come back to my statement of changes in equity, and the first column I will say that I have ordinary. I have ordinary shares. Now this is followed by the share premium. This is followed by the share premium, and then this is followed by the retained. This is followed by the retained. So you arrange in columns, arrange in a columnar format, arrange in a columnar format. So retained earnings, and then after retained earnings, I've seen that we have general reserve. So general reserve. So general reserve. I think we have also seen. So these ones are the ones that we have in the trial balance. But then as per the workings, we've seen that we also, because of the revaluation surplus, we have seen that we have the revaluation reserve. We have seen that we have the revaluation reserve, the revaluation reserve, the ones on PPE. And then we have also seen that we have fair value, we have fair value, we have fair value gain reserve. We have fair value gain reserve. This one is with respect to the investment property, the ones that we adjusted to fair value, and there resulted a revaluation, there resulted a fair value what? Gain. So you must have reserves for the two also, the revaluation, and then the fair value gain reserve. And assuming that this is all, we will have the last column as the total column. So we'll have a total column. So we will have a total column. Now, in a statement of changes in equity, we had agreed that begin with the balance brought forward. Begin with the brought forward balance. And the brought forward balances we had agreed that get them from the trial balance. You go back to the trial balance and get them from there. You know, like for the ordinary share capital, like now for the ordinary shares, like now for the ordinary shares, like now for the ordinary shares, we have an amount of how much? The ordinary shares, we have this 25, yeah, 25,000. And then the share premium in the same manner. From the trial balance, we have how much share premium. After the ordinary share capital, we have this 61. The retained earnings are the same thing. The same thing. And so that for the retained earnings, we have this 188 250. The 188 250. The general reserve, also the same thing. In the trial balance, we had a general reserve of what figure? Now this 142 500, the 142 500. We did not have the other two in the trial balance, so that they are brought forward is there for 0. The other one is also a 0. we can then get the total column as the sum of, the total column will be the sum across row-wise, the sum row-wise of all that. And that comes to 416, 700 and what? 50. The statement of changes in equity, remember, is concerned about the changes on each of these things now in the current year. And something like ordinary shares, we had agreed that you only change this one when you have issued what? When you have issued shares. And rightly so, we have seen that there was a shares issue. And this shares issue was the bonus what? The bonus issue. There was a bonus issue. It was working number, that was working number what? When I go back to the workings, it was actually working number 8. So it was actually working number 8. It was actually working number 8. So working 8. And then so we increase our share capital by the value of the bonus issue. The value of the bonus issue in our working 8 was this 62 at 62.50. Remember that issue of shares increases the share capital. So issue of shares increases the ordinary share what? Share capital. We cannot have a share premium for this issue because the bonus issue is normally done at the par value. The par value only adjusts on the ordinary shares. So this does not affect the share premium, so a nil. We agreed that this bonus issue was financed. This bonus issue was financed by capitalizing the general reserve. So we said you debit general reserve. Debiting general reserve means that you decrease the general reserve by that figure. So debiting general reserve means that you decrease the general reserve by that figure. So it's a positive under ordinary shares, and then you minus under the general what? Reserve. When I go to the revaluation reserve, it's a nil. The fair value reserve, it is also a what? A nil. The total column will have a 0 because the positive and the negative do what? Cancel. The two cancel. So the total is then a what? A 0. All right. Let's go to the retained earnings. For the retained earnings, we have to remember that you adjust it by the loss. By the loss for the period. By the loss for the period. And in this case, you adjust it by the loss after tax, the LAT. The loss after tax. But this one does not affect the ordinary shares, does not affect the share premium. Under retained earnings, the loss after tax, we have what figure? We go back to the P&L, where the loss after taxation was this figure. At 76.60. So it's that negative. So remember, do not take the total, do not work with the total comprehensive income, yeah? Not the final income. The total comprehensive income includes even the revaluation surpluses and the fair value gains, and so that is not what you take to the retained what? The retained profits. So you adjust the retained profits by very simply the loss after what? After tax. The general reserve is not affected by this. Again, the revaluation reserve not affected by this. The fair value reserve also not affected by that. And if that is the case, one more thing that you adjust under the retained earnings is check whether there were dividends, because whenever you pay dividends, you pay them from what? Profits. And so the ordinary shares will be a nil, the share premium a nil. Now, where were the dividends, go back to the trial balance. In the trial balance, there were dividends mahali. Yeah, you can see that there were dividends paid just after the retained earnings. There were dividends paid, so equal to negative that. Dividends you minus because they reduce what? They reduce profits. Dividends you minus because they reduce profits, and so this does not affect general reserve, does not affect evaluation, does not affect the fair value. The total will also be the same dividends of 6,000 what? Now 500. If that is the case, then we can proceed to record for the revaluation reserve. And for the revaluation reserve, the only thing we have is that revaluation surplus. The only thing we have is that revaluation surplus. Remember, for the period, for the year, and the revaluation surplus for the year we had agreed. So this is a nil for the ordinary shares, 0 share premium, 0 the retained earnings, 0 the general reserve. Under the revaluation reserve, I'll say that equal to the revaluation surplus was this 14,160. 14,160. Now that is not adjusted, and the fair values were 0. But we've already seen that this revaluation surplus had some tax effect on it, so that you introduce the tax effect on it. So nil for the first one, nil for the second one, nil for the third, nil for the fourth. Under the revaluation reserve, we have the tax effect of negative 4250. Remember to decrease the revaluation reserve by the tax effect. The fair value reserve is a nil in that respect. And then lastly, for the fair value reserve, this one you adjust by the fair value gain for the year working number 9. So it does not affect the first 5 columns. Under the fair value reserve, we then have this 10,000. And I think that that is it. And I think that that's it. If that is it, then we can add them downwards per column. Like now for the ordinary shares, we have 31,250. We do that to the last column. And so the values that we get here are the values carried forward. Those are there for the values carried what? Carried forward. And so those are now the equity item figures that later we take to our balance sheet. And that is how these are statement of changes in equity should look like, yeah? So that if there are any question.
So for the revaluation surplus, can I give the net figure having factored in the tax, or the format is you first bring in the revaluation surplus and then you bring in the tax effect rather than bringing the net figure?
If you do not separate this way, you will miss the marks for the two. You should not, the net figure should show as the balance carried forward, yeah? Otherwise, for the body of it, you must separate the two the way I have done. You know, these things are marked on entries basis. Like now, this will be a tick. This will also be a tick. The moment you work with the net figure, you'll be getting a wrong, yeah, for that. So make sure that you separate that way. Our Faith.
Okay, so do we have marks for the format, assuming I get the format right, but my figures are not right?
No. There is no mark for format.
Okay.
There is no mark for a format at all. No mark for the format. You must be having the correct figures. What you need to have at the correct figures. Without the correct figures, really no marks. The ticks will be on the ticks will be on the individual entries. So nothing like the format at all. Yeah. Once we are through with the last statement, I'll show you how the marks for can you guys hear me, or you had lost me at some point?
Lost you for a second, but now you're back.
Sorry for that. So let's go to the third. I think when you lost me, I said that I'll be showing you how we distribute marks for this, yeah? I'll show you how the 30, this question was 30 marks. And remember, it was compulsory. It was a compulsory question, yeah? So I'll show you how the marks for the 30 marks are distributed between the 3 required statements, yeah? So let's go to number 3 and
Excuse
last.
me, question.
Yes, Ian?
Yeah. Okay, I wanted to just find out for a limited company, for company limited, you can see the changes in capital where they're being tracked on the ordinary shares and the share premium. But now for sole proprietor, they will be under which line?
Yes.
I'm saying for a limited company, you would see the capital basically on the ordinary shares and the share premium. And for the sole proprietor, which would be the relevant lines?
For the sole proprietor, all you'll have is you'll have profits, and then you'll have the capital, yeah? Because for a sole proprietor, you don't have ordinary share capital. You just have the normal capital, and then profits, yeah? So in that case, the line items will be capital, and then the profits, and then the profits, if at all you have the profits retained, yeah? But again, do not worry about that, because your syllabus is very crystal clear that we only look at the financials of companies.
Oh, okay.
Sawa.
Sawa.
Yeah, focus is on presentation and preparation of financial statements of companies strictly. Nothing like the sole proprietorships, the partnerships, and so on, yeah? All right, so the next statement is the statement of Sofanisi Limited, statement of financial. So statement of financial position, or statement of financial position. We say that is at again 30th June. The year is 2023. So it's at 30th June. The year is 2023. All right, so we will again have our shillings in thousands. We reported in shillings in thousands. We reported in shillings in thousands. And in a balance sheet, we know that, so this is now the balance sheet. We know that we start with the non-current. We start with the non-current assets. And which non-current assets do we have? The most obvious one become PPE. which we had already calculated. Remember, in our working somewhere, that was working number, the PPE was working number 5. So the PPE was working number 5. We had already computed that figure, and we computed how much in working number 5. We computed 214. So that 214. So that 214. I will repeat on this particular item that you cannot come to this balance sheet and start saying that separately you have land and buildings, and then again probably separately you have plant and equipment. That's not allowed. IS1 require that combine them, consolidate all of them, and in this balance sheet only present what? Only present the summarized figure. So that you have to be very, very mindful of, yeah, because like now in the last sitting, this was a catching point with a lot of candidates. Coming here and saying that you have the assets, the individual assets. Now I'm saying that even if the figures are correct, even if you are right, even if the figures for the individual assets are correct, you cannot get marks. So even if the figures for the individual items are correct, you cannot get what? Get marks. So you must make sure that here you bring the summarized, here you bring the summarized figure. And so that is it. The next non-current asset is which one? There was investment property. There was investment property, yeah? There was investment property. Because these ones were adjusted to fair value, what you need is their new value. Whenever you revalue, you look for the new value. And in this working number 9, their new value we said is 147 what? Million. So their new value is 147 million. So 147 million. So 147 million. And then followed by, I think that is all for the non-current assets. And so we can add them. There was no other non-current asset. Once you have summarized our PPE, there should not be very many, yeah? So that gives us about 361. So that gives us about 361. Yeah, so that next we proceed on to our the current assets. And for the current assets, which ones do we have? These ones should be a number. Starting with inventory, the closing stock. Starting with inventory. Now inventory was in working number 1. That's where we highlighted the inventory. So that was working 1. And in that working number 1, how much inventory did we say that we do have? In working number 1, we agreed that the closing inventory, you measured at the lower of the cost and NRV. The lower we found out to be this 95, 250. So that's what you bring down there, yeah? Now this is followed by the receivables. This is followed by the receivables. So this is followed by the receivables. And the receivables include, the receivables were how much? When you go back to the trial balance, when you go back to the trial balance, I'll say that equal to, in the trial balance, the trade receivables are somewhere. And in the trial balance, we had the trade receivables as this 130. It was 130, remember? So it was 130. Remember, 130, remember? Yeah, so that it is 130, but minus, it's 130 minus what? There was some provision for expected credit loss, this 13. Remember, we computed as 10% of the 130, And if that is the case, you say that minus this 13. So what you record is the net. What you record is the net. What you record is the net figure. And that comes to about, down here, 117,000, yeah? So that is 117. That's 117,000. Apart from the inventory and receivables, what other current asset do we have? Let me check in the trial balance whether I had cash and bank. And yes, we actually had the cash and cash equivalents. So that down here, we'll say that we have cash and cash equivalents, cash and cash equivalents. And this one comes to about, I go back to the trial balance, how much is it? The cash and cash equivalents are totaling, in the trial balance, this is 8,000. So that is 8,000. And so that I do not think that we had another one. When I check my trial balance, I do not think that we have another, yeah? And if that is the case, then we can compute the total assets figure. Then we can compute the total assets figure. If I add them downwards, that comes to 581. Remember 200 and what? 250. So that is somebody having a question on the assets before we proceed to equity liabilities? Is there a question on the assets before we proceed to equity and liabilities? Yes? All right, so no question, absolutely. No question from anyone. And so we proceed on to equity section of the balance sheet. And equity, we've seen what equity comprises. Those items in the statement of changes in equity. One we saw is our ordinary shares followed by the share premium. I will just list them first and then followed by the retained earnings, and then followed by general. We have general reserve, and then followed by revaluation. and then followed by the valuation reserve, and then followed by the fair value. There was also the fair value reserve. What we need in the balance sheet are their balances are carried forward. So which I'll copy from my statement of changes in equity. Very quickly, those are the figures which I have. We've already computed their balances for the balance sheet. They are carried forward balances. And so that when you add them downwards, we have seen, when they're added downwards, we have seen, yeah, that we've had a total of 422 something. So added downwards, we have 422, 500, yeah. So that we have seen. So very simply, we get that from the statement of changes, and so that is it. So next we have non-current. Non-current. These are the liabilities. The non-current liabilities, yeah. The non-current liabilities. And the first one here, I think we saw that we have the 8% loan stock. It's obviously the first one. So it's obviously the first one, the 8% loan stock. And how much was the 8% loan stock? When I go to the trial balance, the 8% loan stock is this 37,000, now 500, yeah? That's 37,500. We did not have expressly the deferred tax separately, and so we will not have deferred tax liability under the non-current liabilities. Whenever you have deferred tax, remember it's a long-term liability, and so it should appear here. In our case, we were told about it, but very vaguely. So we just had in general a tax liability. And in general, a tax liability, now that should be a current what? A current liability. Lastly, can we now look at the current liabilities? So lastly, we look at the current liabilities. So lastly, we look at the current liabilities. And for the current liabilities, start with the payables. So start with the payables. And for the payables, when I go back to the trial balance, the trade payables, they must be somewhere. The trade payables must be somewhere. The trade payables, I am looking for them. Where were they? The trade, yeah, the second last item, the 108,500, yeah, the trade payables. We haven't seen on any adjustment for this, and so we just pick it that way. We haven't seen on any adjustment for that. So we very simply pick it that way, And if that is the case, then we proceed to which other current liabilities do we have? Remember, there must be income tax. There must be income tax payable. There must be income tax what? Payable. That is what we were told in note number something. That is what we were told in note number, any expense provision in the notes, like now the taxation, that's an accrued expense, and so that's a liability. Note number 6, we were told that the income tax charge, current and deferred, so the year is estimated at 11,250. So we'll come down there, and of course I say that the income tax payable was note number 8, and this one is 11,200 and what? 250. So the whole of it. So the whole of it is a liability. The whole of it is a liability. The 11,250, the whole of it. Apart from that, what other liability do we have? So this is actually not number 6, not number 8. So not number 6, not number 8. I do think that we can then look for the accrued interest. The accrued interest on loan. There was some interest on loan. Now, when I go back to my P&L, when I go back, accrued means are not yet paid for. You've provided for it, but you've not yet settled it in cash. When I go back to the P&L, I calculated finance cost of this 3 million. So I'll put is equal to negative first 3 million so that I make it a plus. How much of this have we paid, so that we're looking for how much we have not yet paid. So minus what we have paid, minus the interest which we have paid. For what we have paid, you go back to the trial balance. For what we have paid, you go back to the trial balance. Somewhere, I think as item number 6 or 7, item number 6, there was interest on loan stock paid. We paid for this 15. So if the total expense was 3 million and we paid for 1,500, it means we have not yet paid for the other half, which is also 1,500. That's what we have not yet paid for. And so is there another one? Is there another current liability? Yeah, so I am not sure whether we have another one, but I do not think that we have another.
How well do you know about?
I do not think we have another liability, and so we can actually add them downwards to reconcile the balance sheet. Yeah, so that comes to 581, 250. Yeah, you realize that is what we had as the total assets also, yeah? So 581, 200 and what? 250. So is there any question?
Yes, how did we get the accrued interest on loan?
The accrued interest on loan we computed as, I came back to the P&L, yeah? And I looked for the finance cost. Remember, the finance cost is what we call interest. So the finance cost was 3 million. That is what we expensed. So 3 million. So 3 million. So 3 million. And then out of 3 million, when you go back to the trial balance, as item number 6 in the trial balance, we have this interest on loan stock paid. So the expense was 3 million, but what had been paid in cash as of the reporting date is only 15. So it means the other 15 has not been paid in cash. So it's an accrued expenditure. Is that okay?
Yes, thank you.
All right. Ian, do you have any question?
No, that's fine.
All right, so how are the marks for this question awarded? The income statement, The marks are awarded in a manner that there is a 1 mark for the revenue, a 1 mark for the cost of sales, a 1 mark. Now the totals are never marked, like now that was profit, there is no mark for it. So the other operating incomes will have the next one. Each of the expenses will have 1 mark. The income tax will have 1 mark. Revaluation and the tax for it will have 1 mark, and then the fair value what gain. Once again, I've said that the totals are not what marked. But when you add the marks for the income statement, they will total to about that is 10. So the income statement will have about 10 marks. Yeah. So each of those you can evaluate yourself and be able to tell yourself how many you can get. Yeah. Now, when you come to the statement of changes in equity, we mark. Allow me to highlight what we mark. We mark the body of it. We don't mark those current forward balances. Those totals, no. But then the final total for all, now that is marked. When you count, these figures are 1, 2, this is 3, this is 4. Now 5, 6, 7, 8. This is 9, 10, and then 11 and 12. So that will be 12 entries. Those which have colored, 12 entries. That is 12 entries at a half. So those are 12 entries at a half. So they will not have at 1 mark each of them. So the total marks awarded for this, the total marks awarded for the statement of changes will be, so 12 entries at a half will give us 6 marks. So the total for the statement of changes in equity will be 6 marks. And then for the balance sheet, the marks awarded for it, the balance sheet, the marks awarded for it will be, the PPE will have 1 mark, the investment property 1, each of the current assets 1. So the totals, we leave them out so that again, each of the items of equity 1, the 10% loan stock 1, the current liabilities, each of them 1. When you add them downwards from PPE, this totals to about how much? That totals to about 15. So that totals to about 15, yeah? So that 15 plus here we have 6. So what I can do is so that, because 10 plus 6 is 16 plus 15 is 31. The question had 30 marks, so I can reduce for the statement of changes to 10 entries. So I'll look at, so that means I'll not mark this final entry. I'll not mark the final entry. So I'll mark these ones, and then I'll take any correct 10 entries at a half. Now that will be 5 instead of 6. So when you add them in total, you will have the 30 what? The 30 marks. So that nani yako na swali?
That's clear.
All right. So I will be sending this working to your WhatsApp. I will be sending the working to your WhatsApp. So in our next class, which will be on Monday, we shall proceed to consolidated financial statements of companies. We shall proceed to consolidated financial statements of companies. Did you guys see in your WhatsApp yesterday that I sent some Excel with notes on consolidation?
Yes.
You didn't pay attention to that. There's an Excel which I've sent to
Yes,
your
sir.
WhatsApp group. Which I had called consolidated financial statements theory. Uliona kweli?
Yes.
Yeah, so please read through that. Read through that, yeah, so that when we meet on Monday, we shall be looking at a question on consolidation. Yeah, consolidation has been set once in your syllabus, and that was in April last year. So it's a very highly likely area, this sitting, yeah? So please read through that handout so that when we meet on Monday and we'll be looking at the question on consolidation, we are well comfortable with some of the most important rules on these consolidation matters, yeah? So I don't know whether, again, somebody has an issue or a concern, any question, any concern, because I wish to stop at that point.
Yes, you said sharing the video where through where?
Yes?
You said we can get the videos where?
I said, no, I said I was sharing. Which video do you want?
For Monday class, which I said I will not be in here. I'll be traveling.
Yeah, you'll just send to the WhatsApp group your email, eh?
Mm.
Okay?
Oh, okay. Mm.
You'll just send to the WhatsApp your email, and then we will I'll send the videos to your email after class, eh?
Okay.
All right. Okay, so thank you very much, ladies and gentlemen. I think enjoy the rest of your Easter. You now have the whole of today, we are not meeting tomorrow, okay? So that we then meet on Monday, yeah? Sawa.
Yes, thank you.
All right, asanteni.
Yes, thank you.
And all the best. Bye-bye.